This is TreppWire Week in Review for week ending April 29th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, we're in the heart of earnings season, and all eyes are on the big tech firms with mixed results. In economic news, first quarter GDP surprised to the downside, shrinking at an annualized pace of 1.4%. Durable goods bounced back in March. Two indices showed record-setting growth in home prices, and consumer confidence fell in April. Manus, stocks staged a nice comeback today after a sell-off earlier this week. What do you think investors were reacting to?
My guess would be that the GDP number was surprisingly low enough that it made traders feel that perhaps the Fed would not be quite as aggressive going forward with rate hikes. Maybe the Fed would be a little bit more hesitant to push rates up as quickly as people had been betting 2 months ago. Generally speaking, I think the market has had a very bearish tone recently. Volatility has been up. We've seen some big days of selling. We've seen some leveling off of earnings and earnings growth and subscription growth for some big tech names. And I would say for most of the last 2 weeks, the glass has seemed very much half full. Throw in the fact that interest rates on the short end and the long end of the curve have risen sharply and have now leveled off at pretty high plateaus. I think that the sentiment is quite negative, and today had every look and feel of kind of a bear market bounce, if you will. I think that GDP number, gave people some kind of short-term hope that perhaps the Fed will be more measured, but I'm not convinced that this is an inflection point for the market.
Yeah, I would agree, Manus. I think I wouldn't read too much into this week or into today based on this news. I think it'll be important to see what the Fed does after seeing the GDP numbers come out. A couple of other bullet points that were notable this week. It looks like according to the Conference Board Consumer Confidence Index, which they released on April 16th, consumer confidence decreased overall in April. So we've talked about that a little bit over the last couple of weeks of consumer sentiment, what will happen with spending when those confidence numbers start to come down, if and when they do. So we have a little bit of some data on that from this week. S&P CoreLogic Case-Shiller, their 20 city price index posted a 20.2% year-over-year gain in February, which was up significantly from 18.9% in the previous month. Some other interesting stuff related to housing. The census actually came out with a quarterly report on home ownership and occupancy for Q1 2022, which showed vacancy rates up slightly, 5.8% compared to 5.6% in Q4 of 2021. But the rental rates had gone up to $1,255 per month. That looks at both single family and multifamily, looks at a national average of rental rates and occupancies. So I think stocks earnings, we'll talk about that in just a moment. We had mixed bag on that. Some tech companies, seem to do really well and were trading as such. Others didn't quite hit the mark. So I would share your sentiment that this may not be a bellwether moment at this point.
I actually had a different reaction to the GDP number, Manus. I'd like to get your thought on it. Yeah, it was a headline that sounded negative, but when you started to read the details, it sounded like the fundamentals were still pretty strong. Consumer spending was still up, businesses were still spending. And when you saw the unemployment claims number come in, the labor market is still very strong. And companies are spending money on wage growth, right? They're throwing higher salaries at employees. So it's hard to believe that things are bad when you look at some of the underlying numbers.
You bring up some really good points. I think that the wage growth has helped keep the consumer flush. The plentiful job opportunities and job openings have helped boost confidence. Confidence would be a lot worse if the job market wasn't as favorable to employees at this point. And thus far, we've seen a couple of headlines where companies have come out and said that, they're reaching that tipping point where they can no longer pass through inflation-related expenses. And we saw the headline last week, and I think we talked about it, where the Morgan Stanley analyst mentioned that he expected earnings to be disappointing on the basis of companies' inabilities to pass on costs. That being said, your points are good ones, that there are green shoots and silver linings in the economy right now that could allow the economy to not suffer the hard landing that so many have become worried about over the last 2 weeks. The one thing I would say is I don't envy being in the position of the Fed board that has to make these decisions. I think, unfortunately, they've painted themselves a little bit into a corner. They probably should have been tapering much sooner than they started to taper. They probably, well, even before that, they should have stopped buying mortgage-backed securities and treasuries long ago. They probably should have started reducing the balance sheet very shortly thereafter. And they should have raised interest rates probably months before that first rate hike came in. At this point, they are really facing a quandary. On the one hand, inflation has gotten away from us and they have to wrestle that to the ground. On the other hand, pushing these rates up to the level that some are talking about does run the risk of slamming the door on the economy. So, like I said, they're in a tough spot.
Just to jump in with one more bullet here, Manus, I noticed Wells Fargo this week laid off, I think, about 500 of their mortgage producers. And then if you look at the total mortgage application volume, it fell 8.3% last week compared with the previous week. That was from Mortgage Banker Association. So demand is now half of what it was a year ago. So I think, to your point, Martha, there's definitely some green shoots, but there's probably still some stuff out there that, maybe a predictor of what's to come. Some of these companies are starting to downsize based on lack of production capabilities and lack of mortgage applications.
Well, that's a good point, Lonnie, that you bring up, and I'll expand upon that just a little bit. I think Rocket Mortgage laid off 8% of their staff this week, and there's a bank in Troy, Michigan, that also announced that they were closing an office and laying off 500 people, if I'm not mistaken. I can't remember precisely who that was, but I did see an interesting data point that really got my attention this week, and I can't remember who wrote about it. It could have been a Bloomberg story, that the demand for adjustable rate resi mortgages moved up 50% recently. So the demand for adjustable rate mortgages had been about 18%, let's say 3 months ago. It could have been 6 months ago. It was by some metric. They were saying that more recently that had jumped to 27%. And what you're seeing is essentially that instead of getting a 5.3% 30-year fixed rate, they were taking 5/1 ARMs that allowed them to get a 4.5% rate or a 4.25% rate for the first 5 years before it starts resetting annually. That's how this particular resi product works. But what it tells you is that the home buyer is getting close to being maxed out, that a 75 basis point difference in rate is probably enough to tilt the scale for them to pull the trigger on buying a home. And when that happens, you have to start thinking that, we're approaching a top of what people can spend on anything, whether it's vacations, homes, gasoline, et cetera. And I thought that was a very interesting statistic.
Let's talk a little bit about the tech earnings, because there was a lot of focus on that this week. And I specifically want to talk about the impact to CRE. I know in the last, year or two that we've talked, the silver lining in many cases has been tech investment in office space and industrial space and data centers, et cetera, et cetera. Any concern that we're seeing in their reports that that's going to pull back?
Well, my perception, I guess, and this maybe has some significant recency bias, is that, well, taking a step back, there's no doubt that so much of the support for the office market has come from the big 5 to 10 tech names, right? When you look at Google, Amazon, Facebook in New York, Microsoft in Atlanta, Apple in North Carolina, just enormous expansions of space, which has really put a floor under office demand, right? It has kept office demand from falling. My big takeaway this week, and it's not an observation as much as it is a concern, is that just as with the US consumer, the wealth effect is real. When your stocks are up and your portfolio is getting bigger, chances are you're going to spend more on the luxury car than the affordable car, more on the extravagant vacation or the extravagant meal than Applebee's or Disney off-site. And when the stock market goes down, people pull back a little bit. And my question will be, following on COVID and following now a leveling off of some of these earnings, do some of these big guys say, you know what, let's tap the brakes on expansion. Let's not pour as much money into office space. We're not sure how much we'll need. And because we're not seeing the same growth we've seen in the past, let's take our time. Let's not be as exuberant in our plans as we were in the past. Just my 2 cents. It could be dead wrong, and time will tell.
Yeah, I think this is a very interesting question because to me, there's a little bit of a logic violation here. We've seen from the data, and we've had numerous stories the last couple of weeks of companies downsizing their office spaces, people walking away from leases, but these tech companies keep either buying or leasing significant amounts of space, but then also telling their staff that they can work remotely indefinitely. So it's very interesting. I think to your point, man, is, you know, potentially with stocks being up over the last couple of years, they have a bunch of capital. They think this is a long-term, you know, safe place for their capital. You know, let's just walk through a few of them. I think for Meta, it was interesting to hear Zuckerberg come out this week and talk about slowing down some of the pace of their metaverse investments. I think we're still trying to decide exactly what the metaverse looks like, although they did come out and say they're going to debut their first Meta store, which is going to be a VR enabled, you know, store. I think the first few tenants were going to be Ray-Ban and Quest 2, about 1,600 square foot storefront where customers are going to actually be encouraged to use VR headsets, smart glasses, and other, you know, video chat type of products. I don't know what that looks like. I mean, like, that sounds like going to an arcade, but this is retail. So I guess you're going to go in and buy some virtual sunglasses from the Ray-Ban store. I don't know about you. Back when I used to have a Facebook account, you would get these like Ray-Ban hacks, you know, on people's accounts where it was like an ad for $29. So I'm hoping they get the viruses out of the metaverse. So I don't know what to think about Meta. Alphabet, they've been spending big on offices and data centers. Their CEO this week was actually quoted as saying, I'll read you the quote here. It says, "It may seem counterintuitive to step up our investment in physical offices, even as we embrace more flexibility in how we work. Yet we believe it's more important than ever to invest in our campuses, and that doing so will make for better products, a greater quality of life for our employees, and stronger communities." That's the Google CEO. So it seems to me, again, a little counterintuitive. They're telling people they don't have to come to the office, but then they're making these huge capital investments to continue to expand their office footprint.
I think they even quoted that they would be investing $9.5 billion in office space and data centers in this year.
Yeah, I mean, so like what I would say in my simpleton thinking is there's more to the story. There's something that we don't know around their long-term visions. And one anecdote to that, some of these cities that we've seen kind of take over, like Austin, for example, where they were kind of a secondary city, they've become on the national, you know, registry of like top tier cities now because of all these tech companies. They have a very large concentration of tech office users. If and when tech decides to maybe downsize or slow down, they have they're overweight tech in their office sector. They're not very diversified. So it'll be interesting to see. Nashville's the same. There's several of these markets where they've had a huge influx of office tenant growth, specifically in the tech sector, that if that sector slows down, those office markets could be in a world of hurt.
Yeah, we've seen that over concentration play out from time to time, most notably in Houston with the oil industry, that when the oil industry turned south, demand for space in that market became very cheap. And we saw some sizable loan defaults. And what we don't know is how these tech companies will ultimately come out of the COVID and hybrid work scenario or regime, whatever you want to call it, the new normal, and how that will look. And to your point, Lonnie, for some of these big cities, and we've already started to see it in San Francisco, you know, demand can be frittered away very quickly in those areas if companies decide that, you know what, we will give up this space. We will let, you know, 75% of our our company work from home, and that's okay. To your point, time will tell. What I will say about that virtual store, my big fear is that it would be like me trying to sneak into my bedroom without turning on the light so as to not wake up my wife. And the only thing you get out of that, you don't get a lot of gratitude. You get a big stub toe, from the base of your bed. And that's what I would predict in these virtual stores, just a lot of bumping into people and, bruised knees and shins and toes.
Well, I have a quick story on that. I was at the airport in LaGuardia a few weeks ago, and a guy came in with his Oculus headset on while we were waiting on the plane to board. And he was running into walls, literally, like with his headset on. And finally, someone went over and was like, "Hey, you can't do that in here because you're just running around in a circle." So
Yeah, he was killing it in a marathon or something. Who knows what he was really doing?
You and I talked earlier this week about Amazon and their, walk in, walk out store concept. So, I mean, that's kind of like back on the hybrid. Maybe that's the hybrid. Metaverse is completely VR. You go and put a headset on. Amazon Go has this hybrid model where you're still in real life, but it doesn't feel like it because you swipe your credit card, you walk in, get whatever you want off the shelf, and just walk out. And they somehow magically know what you bought and what the price is.
It's so weird, Manus. I did it for the first time this week. I walked into the store. And, I've kind of been afraid to go in because there's a gate in front of it and, it's just kind of imposing. So I walked in there, I picked up something and I said to this lady, I'm like, how the heck do I get out of here? She said, you just walk out. And I said, all right, then. Turned around, left. And sure enough, that's all you got to do.
And it won't be long, Martha, before you forget at the grocery store that you're not in a virtual store and you're walking out with groceries. And next thing you know, you're on a mugshot in the post office. And
that could be bad. So, we joke about that, but, Amazon did talk about its investment in brick and mortar, and they're taking over the infrastructure space that has been historically the land of others. So they're implementing their grocery stores with this just walk out technology in places like Southern California and a bunch of other states. And they're looking to convert their Whole Foods to do the same. So it's an area where we've kind of said, oh, Amazon's not going to go into brick and mortar, but it looks like they're aggressively going and taking technology with them.
Yeah, I would say in this case, Amazon's basically doing their AWS play, but in the real estate space, where they're creating this technology that I see them licensing to other retailers very quickly. And so that's scalable for them. So just to give some perspective on that, when they started their Amazon Go concept, the technology cost per store was about $4 million per installation. They've now gotten that price down to $159,000 per installation. And they estimate, based on some internal documentation, to get that down to $59,000 by 2023. So if that's the case, that becomes something that scales for them as a licensed business very quickly. And to your point, you may see a lot of these other large big box retailers and other industries taking the same approach where they license the Amazon technology. You walk in, get what you need, and walk out. It's a huge cost saver for the operator, more convenient for the shopper, and Amazon gets to keep printing some money.
I hate to be the cynic here, but I think grab and go has already been the model introduced in both Northern and Southern California. And the retailers might find they're installing this $159,000 widget for naught. We'll see. Time will tell.
So let's get to the office sector, which is rife with a lot of stories and some of them not the best.
Yeah, I guess, talking about recency bias, maybe my general glass half empty mindset this week has a lot to do with several stories, some of which touch CMBS and some of which don't, that all seem to be kind of negative on the office space. And so we're a little bit heavy on the crabgrass this week, and I'll run through them very quickly. We put out a trading alert earlier this week that BB&T, which is now Truist, had vacated their presence in Richmond. It was interesting. This is about a $140 million CMBS loan. It backs 3 2018 CMBS deals. It's a big loan. And what was interesting to me is when you scratch beneath the surface on this thing, BB&T did have a termination option that they were allowed to trigger, but it was conditional upon them being bought. And so this now has been triggered. And it's interesting, they weren't quite bought, they merged, but I guess they were still able to take advantage of this termination option. And they will now be leaving this property. I think they've already terminated, and they're on the hook for 2 more years of rent now that they're leaving. Another story that we saw this week, this one doesn't touch CMBS, but it talks about the current nature of the world. Mega law firm Skadden Arps, it looks like they are going to be downsizing in Chicago from 170K at 155 North Wacker down to about 85,000 square feet at 320 South Canal. That is of a piece companies that are looking to shed space. We saw another one, we wrote about this week as well, that in Nashville, the top tenant behind a big 2014 loan will be vacating. In this particular case, Service Source International is the top tenant with 46% of the space. Here, Service Source is moving to a new location, so not necessarily downsizing. But in this particular case, the borrower behind this $26 million CMBS loan is looking for some kind of accommodation with their loan, possibly a early payoff at par due to the fact that Service Source International will be vacating. A couple more that we'll run through fairly quickly. In Oakland, California, the Chevron Federal Credit Union is the second largest tenant at City Square and Clay Street. This backs a $90 million CMBS loan. It makes up a significant portion of 2 CMBS deals from 2018. Chevron Federal will be vacating that space. Moving on very quickly, the bank I talked about before that will be reducing its mortgage staff, Flagstar Bank in Troy, Michigan, that was in reference to Lonnie's downsize of mortgage servicing, and PayPal closing its San Francisco office, which, hopefully it's not a harbinger of what's to come in the tech world in terms of real estate demand. So I raced through those pretty quickly. If you want to see any of our reports on those trading alerts, let us know and we'll send them over.
Yeah, I think a couple of bullets on those, man, it's just to run through them quickly. What we're seeing here is a pretty significant decline in occupancy for some of these office buildings and them looking for kind of a way out. And I think that'll be, maybe a leading indicator for us to kind of monitor. So in industrial right now, for example, if you have a tenant move out, you're ecstatic because your rents are probably below market. You're going to increase the value of the building by releasing it. Some of these office buildings, especially as we've talked about the class B and C, if you go from 95% occupancy to 45, you're looking for a way just to get out from underneath the note and move on to the next endeavor. So it'll be interesting to see how that plays out nationally. I think on the PayPal, just a quick anecdote on that. I know Elon Musk, with the takeover of Twitter, had joked about turning their office on Market Street into the homeless shelter. But I did a little research. That is a property we track in the data set. And Twitter just renewed their leases there, and they actually are under contract, I think, until 2028 and 2029 now in their 2 spaces. So, there definitely be some cost incurred to them to get out of that lease before those expiration dates.
We do have some green shoots, so it's not all bad news.
It's not all bad news, and we'll run through a couple of these quickly as well. TIAA in Dallas announced that they will be moving to a new office near the Dallas Cowboys headquarters, a green shoot for that market. Although I would have to say that, that Dallas, Plano, Richardson area is already a little bit of a tropical rainforest when it comes to agriculture. If we're going to say green shoots, it's probably more of a fauna. Is that the word when you have a lot of green shoots all at once? That
it could be a jungle or
jungle. Yeah, I think
flora.
Dallas, that Dallas area, their cup runneth over when it comes to development and attracting business and so forth. An area that, for which the cup hasn't runneth over has been New York, where the market has been kind of a little bit topsy-turvy in terms of demand and sublet availability and occupancy. But it was reported by Commercial Observer today, I believe, that Wellington Management is going to open its first Big Apple office. It'll be in the Greenwich Village area. It will total about 71,000 square feet at Columbia Property Trust's 799 Broadway. I think actually Commercial Observer reported this, but they were referencing a Bloomberg story. The interesting thing there is they're not taking, the typical space that one would take in Midtown Manhattan or the financial district, right? This isn't Park Avenue or Madison or Sixth Avenue. This is Greenwich Village, an interesting twist there. Wellington has about $1 trillion under management at this point. And I do think that over the years, they've been a big CMBS investor, if I'm not mistaken. Lastly, we did put up a story about 101 Shoreline in Mill Valley, California. There, we were very concerned a couple months ago that Glassdoor was vacating the property. They were going to leave a sizable hole in the rent roll. It's about 100,000 square feet. But the owners of that property have since signed 6 leases and have fully backfilled that Glassdoor space. And this is now no longer a big loan of concern for us. DSCR had fallen to 7.77x and occupancy was 49%, but that should improve as 2022 goes on. And I hate to leave on a negative note, but I'll throw one more thought out there on the crabgrass side and let Lonnie and Martha react. We also saw a number come out today, which probably also added to my angst in this segment of the market. Castle Systems put their latest 10-city number out there. Pretty sizable drop. They went from 43% attendance at offices in their top 10 cities that they focus on down to 40% this week. So, you think this time of year, it's not summer, so people aren't taking vacation. It's not COVID heavy time, so people aren't trying to distance as much as they were in November, December, and yet big dip. Maybe the holidays, I don't know.
Yeah, I think it's got to do with holidays. Anecdotally, I know a number of people took holidays around Passover and Easter, either the week before, the week after. So I'm hoping the number is reflective of people that were just taking time away from the office.
Fingers crossed for sure.
Let me jump back in while I have a chance on this Dallas story, man. So I can't pass it up because the TIAA facility they're going to move into is actually at the Dallas Star or the Frisco Star, where the Dallas Cowboys are headquartered. So while we can't win a playoff game, we can barely make the playoffs. The Cowboys are still undefeated on their practice field. So we have that going for us.
Well, we do know, hope springs eternal when pitchers and catchers show up for spring training, right? Everybody is 0-0. And even if you're the Pittsburgh Pirates, you can hope that October will bring a postseason bid. Today is the football equivalent. It's the NFL draft. And, for all those, 7-figure salary college coaches that are going to lose guys tonight to the NFL, I would point out to you that Lonnie still has a couple of years of eligibility. I have no idea what position he plays, but he's a guy that didn't burn all his eligibility a decade or two ago. And, you put him in, coach, and he's ready to rock.
Yeah,
he's laughing.
The hamstrings are a little tight, but I could probably loosen up pretty quick. I will say early shout out. Joe M made his first trip to Texas this week and was actually in the Plano suburb. And I got a text message from him that said he drove by the JP Morgan campus in Plano and he said it was unbelievable, the new age equivalent of a company town. So I think Joe M now knows everything is bigger in Texas. So little shout out for Joe M.
We'll have to find out if Joe has any eligibility. You guys can go as a paired offering,
package deal.
just like Tom and Gronk, right? You can make yourselves, negotiate in tandem.
That's a picture worth 1,000 words right there. I'll leave it at that.
Yeah, so let's jump on a couple of these Blackstone stories that made some headlines this week. So Blackstone, we've talked about them, I think, on every podcast for the last 6 or 8 weeks because they've been on a buying frenzy. So last week we talked about the American Campus Communities acquisition. They had a deal with Landmark a month or so ago where they bought about 2,300 student housing, units, and then now. It was announced this week that they've entered into an agreement to buy PS Business Parks for $7.6 billion. So this deal includes 27 million square feet of business parks, office properties, industrial space, and rental housing across 4 states. I think the aggregate price per square foot, almost $300 for the industrial space, which is just off the charts. So they're not stopping at student housing. They're buying up companies where they feel like there's inefficiencies and opportunity. PS Business Parks actually has a really good portfolio. I am fairly familiar with some of the stuff that they own and operate. So they've benefited from a lot of their flex industrial deals in this market being underpriced. So pre-COVID, when office rents had gotten to the peak, some of their flex space were being used as offices for tenants that have been priced out of the market. And then now that the industrial market's taken off, those rents have, I would assume, gone through the roof. They had one other deal here, a subsidiary of Blackstone, paid about $150 million for industrial and office buildings in Waukegan and Zion, the biggest Chicago area industrial property sale of 2022. So the New York-based Link Logistics was a subsidiary. They bought 12 properties from the New Jersey-based PGEM Real Estate, according to Cranes. It was the latest big splash for real estate in the area. The portfolio of industrial buildings Link recently bought include 1.4 million square foot across 4 office buildings, most of them located in the Amherst Lake Business Park, which is in Waukegan. The sale also includes a 150,000 square foot industrial building at 451 Trumpet Park Drive in Zion.
Yeah, I think we're going to have to rename as an economy Blackstone to Black Hole, right? They just keep sucking in everything, within their orbit and just keep pulling it into their corporate orb. It's just becoming a behemoth at this point, right? The gravitational pull is so enormous that, nothing can escape its clutches these days.
On that, real quick, Manis, do you think that's a byproduct of them having superior systems, talent, insights, analytics on markets where they think there's alpha? Or do you think it's just them having access to unlimited capital, lower cost of capital, and the ability to go in and say, we're going to be in this for the long term, so we're willing to overpay today. We can embrace a downturn in the market and survive, and we know on the other end, we're going to come out on top?
I think it's a little bit of both. I think the scale, your first point, is enormously beneficial. They can run these things. I mean, they've always been smart guys. They've always been smart operators. They're good at what they do. And the bigger you get to a certain point, the more efficiencies of scale you can have, and that works to your advantage. So there's certainly that part of it. I think that's enormous. If I were to handicap the two, however, I would say an even bigger advantage would be that lower cost of capital that you referred to in your second point. I would have to say that between them and other well-run operators that are approaching scale, they still have probably a 50 to 75 basis point funding advantage. And when you compare them to the guys that don't have scale, that would like to get to scale or don't have the track record or are still kind of getting there, it might be more like 150 basis points or 200 basis points. And that just gives you so much opportunity to, up your bid to beat anybody. And I think that's such an extraordinary advantage these days. And it's very hard to compete against that.
Okay, turning to multifamily, we talked a little bit about this last week. We talked about the fact that we did a deep dive on NOI in the multifamily sector, and we finalized that report and just released it. Looked at Freddie Mac multifamily loans for the last couple of years for their income, and we've got some interesting preliminary results from the data that we've collected thus far.
For those that don't remember, we talked about this 2 weeks ago. What we tried to do was look at the early reports of full year 2021 NOI for the multifamily sector using Freddie Mac loans. Obviously, Freddie Mac, a huge player in the multifamily lending / securitization space. When we started this analysis, we saw about 25% of the market had reported full year 2021 NOI and so forth. We teased one of the numbers a couple days ago, or 2 weeks ago, when we said NOI growth was up in the low single digits, 4%, with an outperformance in the markets that you would expect: Southeast, South Atlantic, Southwest, where that was kind of more mid single digits, 6-7%, something like that. But we went back and added another dimension to this study, which is also part of the analysis. we wanted to see where the NOI growth came from. Was it top line or slower growth in the expenses? And maybe Lonnie will feel differently. We'll give him the chance to weigh in on this in a moment. But I was a little bit blown away by the results. We saw that on average, the top line grew about 4.5%, right? So revenue for loans 2020 to 2021 grew by 4.5%. Expenses grew by about 5.1%. And for those of you that have an abacus at your desk, you're probably thinking, how is that possible that NOI went up even though expenses outpaced revenue growth? And the reason for that is, revenue is about twice the size of the expense line item. So, all things being equal, a equal growth in revenue percentage-wise and an equal growth in expense percentage-wise will have your NOI grow, right? That may not be intuitive, and it wasn't for me in the beginning. I had to go back and reset my abacus, but I was shocked. I would have thought 2020, a lot of deferred income, a lot of people not paying rent, a lot of people moving back with their parents, a dip in delinquency. We saw that, a dip in occupancy. We saw that in droves in New York. Huge rebound in 2021. I expected the revenue number to explode higher and expenses to stay flat. Dead wrong. Go ahead, Lonnie. Give us your hot take.
Yeah, so I think a couple of things on the Freddie Mac deal specifically. I think by definition, they're stabilized assets when they get the financing. So I'm not completely shocked at the numbers. I would say it's still healthy. 4% NOI growth is still a relatively solid number. I think if we did a similar analysis on the CRE CLO products, which by definition are value add, reposition, story loan type of properties, we're probably going to see a significant uptick in the NOI. So that would be one immediate takeaway. The other thing is, as you mentioned, just the magnitude of revenue relative to expenses. Those percentages can be a little tricky at face value. Just as an anecdote, I found some stuff that Equity Residential put out this week in some of their reporting. Same store residential results by market. They compared fourth quarter 21 to first quarter 22. They looked at markets like LA, Orange County, San Diego, San Francisco, New York, Seattle, et cetera, some of their top tier markets. On the whole, revenues were up 1.1%, but expenses were up 5.9%. And their overall NOI growth was actually a net negative decline of 1.3%. Now, it's a very small subset, and it's looking at fourth quarter to first quarter, so it may not be apples to apples. But I do think we're going to start seeing some of these operators or owners that have benefited from significant revenue increases. If those start to level off at all, the inflationary cost for these operating companies, labor is more expensive, repairs and maintenance materials are more expensive, et cetera. Those expenses are going to be coming with a vengeance, and we're going to start seeing a leveling off, at least based on this Equity Residential filing, potentially no growth or slow growth on the NOI side.
Yeah, I guess so much of my surprise was, and maybe this is just the press being the press, and that they will grab on to scary headlines to drive clicks and eyeballs and so forth. But it just seemed like the whole second half of last year was headline after headline after headline of people looking at 8 and 10% rent hikes in their multifamily apartments. And I guess having seen so many of those over the last 6 months, I thought that top line number would be a lot more severe than it was. Now, we all know that leases end kind of theoretically equally in 12-month installments. So if people were starting to jam these through in October of last year or August, they're only halfway through their cycle of making people pay more rents. So maybe we'll see more of this when we compare 2023 to 2022, right? Maybe that is part of the story that defines only that 4 or 5% rent increase this year. But color me surprised by the whole thing.
Well, let me harken back to my property management days. I actually cut my teeth in the CRE business as a property manager in multifamily. I worked for a company that did new construction, lease ups, Section 8, et cetera. I love multifamily. I have an affinity for it. That's where I got my start in the business. It's very localized and market to market in multifamily. So I think if we ran this instead of a holistic average and we looked at maybe the top 10 markets or the top 20 markets, to your point, Manus, we may see significant growth in a few of those subset markets and then much smaller growth numbers across the whole. And so I know from my experience, even within the same city, if you're in a Class A submarket, you could be 4 blocks over and it's a Class B submarket. Those rent patterns and operating costs are significantly different, even though geographically they're very close in proximity. So I think multifamily is very localized in that respect. So in this example, we're getting just the rough average. If we went and looked back at the report and said, let's look at Atlanta, DFW, Houston, et cetera, we might see some different numbers on the growth side.
And just a reminder, you can get a copy of this. If you're not on our mailing list, just ping us at podcast@trepp.com. And Haley or one of us will make sure that you get a copy of this. It's very interesting. And we're going to repeat the process in about 2 months when we get closer to 100% reporting levels from all the borrowers, and we'll see if those numbers hold.
Yeah, so Manus, we'll definitely check back in on those financial numbers here in a few months. But we did have one multifamily story to cover, which again, Haley Sound the Sounder, record price, 240 unit Tampa community, sold for 50% above the 2020 value. So Bainbridge, Ybor City, a 240 unit multifamily community at 1512 East 12th Avenue in Tampa, acquired by an undisclosed buyer. The news was reported by Multifamily Real Estate. It was a new construction property built in 2018. It backs a $41.37 million loan, which makes up about 4.3% of a Freddie Mac 2021 deal. Matures in 2031 and can be prepaid with a 1% prepayment penalty. For the first time in 9 months of 21, the loan posted a debt service coverage ratio at the net cash flow line of 2.73, super strong occupancy at 96%. And the complex was valued right around $60 million in 2020. Sales price was at $90.7 million. So again, 50% above the 2020 value.
And a shout out there to Jen, who pulls this data for us and writes up a lot of these stories. So good on her.
We have a couple of quick retail hits.
Yeah, the one that got my attention this week was the talk about Simon and Brookfield potentially jumping in to the pool for bidding on Kohl's. We had seen some private equity players already make bids for Kohl's to take them private. I think there had been 2 expressions of interest or bids in the past, and now you have Brookfield and Simon in there. Couple takeaways for me of this. It's of a piece that we talked about a month or 2 ago when the first bids came in, and that is good for the shareholders, not necessarily great for landlords. And I'll say this on 2 levels. The first is Kohl's is not generally located in shopping malls. They tend to be more in shopping centers, the kind that would have a Burlington, a Petco, a Best Buy, something like that. So they're probably not huge presences in the Brookfield and Simon malls at this point. And so part of that bid could be, where are you going to close them down from where they currently are and put them in the vacant space that we have in our malls, right? And if that happens, that's a net negative for that landlord that has them next to the Best Buy and the Burlington and so forth. So that's something to watch. They also said that they would look to cut $1 billion in costs, which, we don't know a lot about the details of how that would be, but part of that you would have to think is, as they are getting rid of leases at some of these landlords, they're effectively putting in their properties where there is a benefit that is intangible, meaning they only have to charge Kohl's a little bit of rent, put them in the old Sears or Macy's space, and whatever rent they get is gravy. The real benefit is that they can maintain their inline guys. So a lot going on there. Again, I think it's good for the Kohl's shareholders at the stock level, perhaps not good for shopping center owners that are not Brookfield and Simon.
Yeah, I would agree with everything you said there, Manus. I think Kohl's is interesting too, because about it's been a while since I've looked, but I think about 15 to 20% of their stores are on a ground lease. So they don't actually even own the underlying land that the buildings are built on. So that maybe complicates that for the existing landowner if Kohl's vacates. And to your point, this is a bolt-on strategy. If they can backfill their empty spaces with Simon and Brookfield with Kohl's, it's gravy for them. Foot traffic goes up. Co-tenancy clauses maybe don't kick in. So I think this is definitely a strategy. It's interesting as a consumer, we want to buy discount clothes on sale. Simon wants to buy all these going out of business discount retailers, it seems like. So this isn't the first time they've tried to do this. And so we'll see if they can execute, and it could be beneficial for Simon for all the points you made.
Stay tuned.
And the last story in retail is a retailer headquarters sold.
Yeah, so this is another one, 31% above the 2017 value. This is part of a 2018 CMBS deal. This is an Academy Sports and Outdoors just outside of Houston, Texas, in Katy, suburb outside of Houston. Was acquired by Murray Asset Global Investments for $190 million for the center. Comes from the Houston Business Journal. 1.5 million square foot distribution center at 1800 North Mason Road. Academy Sports is a sole tenant on the lease that runs until 2032. The address backs $78.8 million CMBS loan, split between two 2018 deals. 46 million of that is an UBS CM 2018-C8, which is part of CMBX 12. And then the smaller portion, 32.8 million, which is about 4.7% of a Wells Fargo deal, WFCM 2018-C43. Loan matures in 2028 and can be prepaid with yield maintenance. At this point, yield maintenance total would almost about 12% of outstanding loan balance based on recent interest rates. And most recent debt service coverage ratio is about 1.44x. Complex was valued at about 144 million in 2017. So a really good sale for that suburb of Katy, Texas, with Academy Sports and Outdoors distribution.
The thing for me there, I'm sure that there's some people, who are doing the work to buy this property. We're thinking, even if Academy goes south, we're left with a great distribution center in a great market at a time where distribution centers are in great demand. But, the glass half full part of me looks at this and says, this is a retail tenant. They have everything. Retailers have been on the ropes for a long time. It's not something we haven't seen before, right? We've seen the Sports Authority liquidate in the last 10 years. And so somebody's making a leap of faith, because you're not just buying the property and the land and the location, you're buying the credit, the ability for this tenant to be there for the next 10 years and make payments and stuff like that. And so for me, this particular sale is a leap of faith and a sign of confidence for both that retailer and for the retail market. So I've been somewhat negative today on some of our stories. So this is a positive one to kind of end the property sales segment of today's episode.
Well, quick nugget on that. I'm actually fairly familiar with this deal. In the deal documents, Academy had a right of first refusal on this that they did not execute at the sale. So that may speak a little bit to maybe some of your concern in the long term here.
So let's do our shout outs of the week. Mike M, CRE valuation guy, he responded, Manus, to our which record would you buy on Record Store Day? Who's next was his vote. He says it's the greatest rock and roll album of all time. Loves the podcast. It's
certainly in my top 4 or 5, depending on the week you ask me. It could be number 1. It's right up there with Live at the Fillmore East and Eat a Peach and, Born to Run and a couple of others. So he and I are of like mind.
All good. And Oz had a number of comments. We had him on a podcast about a week and a half ago. If you haven't listened to it, you should go back and listen. He talked about student housing that we were mentioning in our last podcast. He wasn't aware that some of these properties are directly on campus land. Made him ask, does the CRE investor actually own the real estate? Which is hard to believe given that it's a building in the middle of a campus. So Lonnie, that's a little research for you.
Yeah, what I'll tell you is these campuses use every advantage they have to get private commercial developers on their campus with some sort of tax abatement, tax-free use. ground lease. There's a whole lot of complexities around that, but they're very good at making sure they can get top-notch operators on their campus to drive campus enrollment.
And Manus, a chance for clarification. He begged to differ that there is no crying in real estate and gave some examples where someone locks into an interest rate with a prepayment penalty, rates go down, there's crying. And he's got some other examples. So he thinks there's plenty of crying in real estate and thinks that perhaps real estate is a contact sport instead.
Well, I will amend my comment. When I talked about there's no crying in real estate, it's really when people are giving up on a property, right? When you sell the house that you grew up in or your parents sell it, there's a lot of nostalgia and emotion that goes into this. When somebody at a big REIT says we're throwing in the towel on there, I don't think that there's a lot of emotion. There's just numbers there. But I would agree with Oz that when people overpay for a building and people lock in on 10-year fixed and realize that they're going to have to pay a big defeasance cost to get out of their long-term debt, I do think that there's a lot of gnashing of teeth, probably some whining, and from time to time some tears. So I'm agreeing with Oz there. I will correct the record.
And Private Eye Cap was on Twitter that asked about IO, interest only bonds. We were going to talk about that, but I think we've run out of time. So we will definitely get to it next week as we run out of time today. Joel, a longtime listener, I think he golfed with you, Manus. So hopefully
this is our second time. He's a CRE guy. He's a data guy just like me, and he likes his golf, and he was gracious enough to invite me out 6 months ago. So I was able to reciprocate this week, and I gotta say, he punched me in the nose and stole my lunch money in competitive terms. Joel, he just kind of took off from the first tee with an impressive front nine and shot just a 41 in the back nine, which completely left me in the dust. So good on Joel, man. He just he had a day. If I had a day like that, I'd probably sell my clubs because I'd say that'll never happen again.
That's it.
I've reached the summit.
Lightning won't strike again. Alec P, who says Lonnie is a worthy addition to the pod lineup. Lonnie, I don't know if that's a resounding endorsement, but we'll take it.
Well, hey, actually, Alec P followed up on LinkedIn with me, and 2 points. One, he gave me some kudos for the Bone Thugs and Harmony last week. Said he's a huge fan, and he actually invited me to speak at the University of Denver coming up here in July. So,
yes.
So we're going to get that taken care of as well. So
awesome.
Good to hear from Alec.
That's great. And Black Eagle Real Estate Devon tweeted at you, Lonnie, and she said she met a grad who was in your appraisal class and said that person is absolutely a rising star in CRE. So good on you for possibly teaching this person all they know.
It's either the knowledge I'm tossing out there or the tweed jacket I wear in class. I'm not sure which one it is.
A little of both. So guys, it's official and there's not any fanfare, but COVID's no longer considered to be in the pandemic phase. And interestingly enough, I noticed this week that Morning Consult's comfort level that they rate of various activities, shopping, vacationing, and dining out have very high comfort level, above 70%. The things that are the laggards, going to the theater and going on a date. I just want to say Manus's hair is particularly coiffed today, so I think he might be going on a date.
I do have a social engagement tonight, and I'm looking forward to it. It's nice that we can all get together again and not be distanced or masked, and I think that's a wonderful thing. I think on the dating front, I think there's a lot of social anxiety coming out of the pandemic. People haven't been meeting in person, and getting over that hurdle and so forth is challenging. I think, going back 3 decades, I think it probably would be for me. And I think on the theater side, I think they just got to put out better product. That would lure people in. I don't think it's the experience. I think it's what they're showing.
I hope they're listening. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it might be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
Let's go Giants.